Hi, this is Eric Boyce, CEO and Chief Investment Officer for BKA Wealth Consulting, and welcome to Charts of the Week for September 6, 2021. Please see our disclaimer for important information. Well, hope you all have enjoyed a wonderful Labor Day weekend. As we get into the news you can use this week, I thought I'd revisit some charts on the coronavirus, which we haven't really talked about in a couple weeks, so it's worth checking back in, especially with regard to the Delta variant, and there's a lot of information out there, some misinformation, a lot of confusion and questions going on. So I thought I'd kind of level set, at least from my perspective. So this is a logarithmic chart of 7-day moving average daily new confirmed COVID-19 cases per million, all right, for the United States, and you can see the trend line here. So the important takeaway in this logarithmic scale is the fact that you're seeing a deceleration in the rate of growth in these 7-day averages, and that's profound because we've anticipated a cresting of new cases, right? Because we've had an acceleration that's been well documented. And we're beginning to see that kind of crest and maybe even begin to turn over, which is a profound, development here. So you can see that, obviously, last year we had a spike, we had a late summer spike, and then obviously the initial spike. But you can see that this is, from its kind of interim trough there at the beginning of the year. You can read into this chart right here to see where this anxiety has emanated from since June, right? We've had a massive increases in cases and whatnot, but it's beginning to crest, and we've got some other charts coming up here that will kind of illuminate additionally where we are on this. All right, here's a chart that kind of plots the US against other countries from the New York Times. So you can see Spain, you can see the UK, India, France, Thailand, Indonesia here. And, there's a lot of noise on this, but this is the kind of tracking new daily cases per 100,000 from the beginning point of the surge, right? And so what you can see here is that on average, very loosely defined, but on average, you're seeing the caseloads in these other countries kind of crest about 60 days. You can see that that's kind of where we are right now. And so, and we are, by all appearances, cresting on the coronavirus. You can see India, which was a poster child for kind of a humanitarian crisis there several months ago. They've crested. UK has had a little bit of a resurgence. After they crested and dropped. So some of this, I think, in the UK has to do with the kids going back to school and the fact that kids aren't vaccinated yet. Now, it'll be curious to see what happens here in the US because we are having a noticeable increase in youth-related infections because kids are at school, and the Delta variant is arguably 3 times more communicative than the Alpha variant that we were discussing last year. But the key takeaway here is that 60 days seems to be kind of an interesting inflection point here. And so we'll just have to watch, as we look at it through both an investment lens as well as an economic lens, where we go from here. Looking at this, we've got 2 sets of data. I thought this was very interesting. So on the left-hand side, we've got this breakdown between metro areas and rural areas. And so we know that most of the population, by and large, lives in urban centers, and that's metro. So that's in the pink. And you can see in that pink line on the left-hand chart that it's beginning to crest over, right? So that's what we've been looking at in these last couple of charts, is this cresting over. But what's interesting is the rural territories, again, representative of the minority segment of the population, continues to rise. And you have less vaccination in those rural areas. You have, I'd say, in many respects, lower levels of education about the virus. I'm not saying that these people in the rural countryside are not intelligent, but there's just less information perhaps available to them, and they're less their healthcare educational resources are less available to those types of folks. But anyway, so that's an interesting dynamic that we got rural versus urban trends here, and urban trends seem to be settling down a bit. Now on the right-hand side, we've got hospitalizations, and so these are admissions with confirmed COVID cases. And we've been talking a lot, or excuse me, the media rather has been talking a lot about ICU bed capacity constraints, and that's a real thing here. But I think what you can see in this chart is not only if you look at the kind of the formerly hot spots of Florida, Texas, which represent huge population centers, those are rolling over, as well as the rest of the U.S. You can see that gray line beginning to trend over. So that's a very important inflection point where we stand right now. All right, well, so here in continuing with this COVID update, I don't want to belabor all these points, but this is a vaccination chart. It's showing you the rate of vaccinations actually going back to the beginning of the year. And so obviously we had the early spike when people got the shot, got their second shot, and then now we're beginning to see a few people now are getting their third booster shot, and I think that is going to definitely become a thing here in the fourth quarter. But as we enter September, we can see that the emergence of the Delta variant is causing more people to get vaccinated, prompting more people to get vaccinated. And there's still, millions of people out there that have said they want to wait for formal FDA approval. Pfizer has it, Moderna does not yet, but it should relatively soon. So those trends are improving as well. All right, well, here's our high frequency data. And, again, it's, we were very excited about this high frequency data for many, many months, and then Delta variant kind of came to the fore. And we can clearly see the impact of Delta in the data. Not only is it causing some, exacerbating some of the labor shortages, people aren't able to come to work, or they don't want to come to work, and so their capacity in retail outlets and things like that is less, and people aren't showing up to work, so on and so forth. That's having an impact, and that, in fact, the high frequency data, that the trends that we're seeing here. Again, if you look at that change month over month, the MOM, you can see some clear read-throughs here, and motor gasoline, that has something to do with the fact that we're after the travel season, we're in school, so on and so forth. So to a slight degree, you've got TSA checkpoint data, motor gasoline sales, and commercial flights kind of impacted a little bit by that. But yeah, you're still seeing open table impacted. You're still seeing hotel occupancy impacted like that. And to some degree, you're seeing kind of a muting out of some of the industrial numbers like rail car traffic and steel production, so on and so forth. Labor numbers remain really, really good. Unfortunately, on the labor side, there's more people that are exiting the workforce, and so basically it becomes a math equation. So you've got more people that are displaced that are not in the workforce, and so the labor, the amount of people that are employed relative to your labor force, might appear a little bit more robust than it probably is. But I think as long as we have the Delta in the mental calculus here of America, I think it's going to weigh a little bit on consumer sentiment, consumer behavior, and I do think it's going to have an impact on third quarter economic growth. In fact, in some estimates, I see it coming back down from 6 to 7 to maybe 3 to 4%. That might be a bit draconian, but because I do think that we're going to get a boost coming out of inventory rebuild, and I believe we have a chart that kind of highlights that. But so I think there's some offsets, but I do think Delta is having an impact on these numbers and on overall economic growth. Here's some other charts related to the high frequency data. Again, don't want to dwell on this. In the upper right hand corner, you got TSA checkpoint data. That is actually following the trend of 2019. So again, I think the TSA checkpoint data has a lot to do with just normal seasonal factors, even though the aggregate number of pass-throughs at airports is lower than it was in 2019. It's still a lot higher than it was last year, and we can be grateful for that. Open table restaurants, now that, on the other hand, is, I think, kind of a poster child of what the Delta impact looks like. Again, not catastrophic, but it's kind of slowing things down. It's kind of pulling the data in a little bit. And then down on the bottom, labor market looks really good. Initial jobless claims is still holding in a level kind of below 400,000. Continuing jobless claims looks really good. We've recovered a lot of these continuing jobless claims. That number's dropped significantly over the last several months, and is kind of emblematic of two things. One, people are getting back into the labor force. Now, all of the extended unemployment benefits are now gone, essentially. So it will be interesting to see what these numbers look like going forward. Now, so far, there hasn't been a material change in labor overall because of this. We know that employment costs and wages are moving higher. That's well documented right here. So we're going to have to follow this, but the labor market as a whole is in really good shape. All right, I've got a couple of charts. We're kind of meandering a little bit here. One thing I thought was really interesting is deal activity and venture capital fundraising. And, these are, this is the non-bank sector. This is the, people that and investment companies and high net worth individuals that are willing to commit risk capital to projects and growth. And this is, to see numbers this high is really healthy, I think, in many respects. So, just suffice it to say, there are three charts on here. The mega deal activity, just in the first half alone exceeds all other years individually by themselves. So we're on pace. We're already at a record point and on pace for a tremendous 2021 in terms of mega deal activity. We're on a tremendous pace for venture capital fundraising. In fact, we're almost in just 6 months where we were in all of 2020, which itself was a record year, as you can see, data from PitchBook. And then, a lot of this money is going into, frankly, the money's going into all levels, whether it be seed or early venture, but a lot of late venture capital money is being raised. And these are for kind of seasoned, perhaps post-revenue companies that are private that, there's just a lot of liquidity chasing projects right now, a lot of liquidity chasing companies for investment, a lot of liquidity looking for a home, a higher and better use than just sitting in money market accounts, et cetera. And the activity here is very robust right now. All right, we're going to look at some economic data. So this is the Institute for Supply Management Manufacturing Purchasing Managers Index. We're off our peaks. The data came out this past week. It was a little bit, soft. I'm not going to say, I'd say the actual was a little bit better than expected, but it was softer than it has been. But, as I've said, this is a diffusion index. So any reading above 50, and I'm specifically now talking about the upper left-hand corner of this. Anything above 50 represents expansion, and anything, frankly, at or above 60 represents phenomenal expansion. That's where we are now. Now, if you go down to new orders, which is moving down in the lower left, you see that number was well ahead of expectation. We're at 66.7. So we don't have a problem in manufacturing. We don't have a problem in with the exception of backlogs, which is what is on the right-hand side. And so we still have these supply chain choke points, which we heard about in earnings reports for the S&P 500 here in the second quarter. Now, no doubt we're going to hear about it in the third quarter as well, but there's still a lot of backlog out there. There's a lot of demand that is prompting, these choke points in the supply chain, the semiconductors, raw materials, the shipping costs, international, especially seaborne freight and container freight rates are just through the roof right now. And it's a real problem, and I think it could contribute to this really strong vibe of transitory inflation right now. And so goods getting across the oceans from their production sites are just flat out costing more. But backlog of orders is high. Again, I'd say in some sense that's positive because there is a backlog, but in another sense, it's a question of how it can be serviced and how that backlog can hopefully get worked down because it's really well above historical levels. Okay, so we're going to shift our attention now to inventories. And so, as I was alluding to in the prior slide, we've got a massive buildup of orders that cannot be serviced because of supply chain choke points and constraints. The good news here is that inventories are moving higher, finally. They've really struggled to get out of the starting blocks. In fact, it was a bit of an anchor, if you will, even on a relatively strong economic growth number. But it could have been a lot higher had it not been for the ability to replenish inventories. And so inventories overall remain fairly low. Inventory to sales numbers remain held in check. But the good news is that at least from the ISM manufacturing PMI data standpoint, that number is perking up. That's very good. And I think this is going to have a positive impact on economic growth that's maybe not as well understood as it potentially should be, because I do think that it's going to have a real positive influence on economic data in the quarters to come. And here's a quick check-in on auto sales. Not a huge surprise here if you've been looking for a new car for a while. Lots of stories of cars that are piled up in storage locations just because, they're about 80% complete, but they're missing semiconductors and other, critical components. And so we know that auto sales are down. And this is clearly an inventory problem. In fact, it has, this auto sales, just because of the high dollar ticket value of the durable good, it's having an impact on retail sales, on durable goods shipments. It's having an impact on a lot of different things, and it's actually also driving the cost of vehicles higher. But you can see that auto sales are down significantly, almost like a pandemic-like shock here, and with prices kind of moving the other way. Here's a slide on private construction spending. I thought this was a very interesting slide because it shows the massive divergence between residential and non-res, meaning commercial. So residential, obviously, we've got a housing shortage in a lot of key markets that are driving home values a lot higher. So you've got a lot of activity there, a lot of spending there. However, we've been relatively muted. And I'm going to say really for like 2 to 3 years on the non-residential side. This is not a new phenomenon. This is a trend that's been continuing for quite some time. And I think it's apt to say that non-residential spending may be somewhat subdued for a while because the pandemic has proven that people can work remote. Companies don't necessarily need as much office space, especially in the urban core, which I think is going to be an anchor on non-residential spending, probably for at least the interim. Meanwhile, I do think residential spending is going to continue to trend higher from here. Now let's shift our focus to the global marketplace. Again, we've been talking about the US, and this is the JP Morgan Global Manufacturing Purchasing Managers Index. And what you can see here is that it's, we've had the recovery, we've exceeded pre-pandemic levels globally. Again, this is, what we've been talking about in this global recovery, but it's stalling out a little bit. Delta variant has something to do with this. Law of large numbers, as we've recovered and now we're kind of settling in. We're still in an expansion mode. Again, this is another one of those diffusion indexes. So anything above 50 represents a positive environment. So, I'm not hitting the panic button, but, it's clear that we have rolled over a little bit from where we were. And to this respect, or to this point, rather, I'd say, in reflecting on this through the lens of the investment markets, this would tend to suggest that equity returns over the short term, short to intermediate term, are not necessarily going to be as good as they have been, globally. But I do think there's probably some rotation, or at least some recognition, perhaps, that U.S. markets are much more overvalued than international markets, which have been somewhat unloved. But that's where all the value is. The valuations are a lot lower, even though we have seen this rolling over a little bit. It still indicates expansion. I think it would require a lot more of a pandemic issue to cause this thing to go below 50. But given that, I still think that there's opportunities for international diversification, so on and so forth. But we'll continue to monitor. Now, a quick word on China. So I think it's clear, looking in that kind of that amber line, the official Chinese Manufacturing Purchasing Managers Index. And so this is kind of pushed forward 3 months, and just for illustrative purposes. And whether you're advancing it 3 months or not, the data is weakening. And so we know China has had a problem with this virus as of late, and we know that it's impacting their manufacturing sector. And so the theory is that China manufacturing slows. It's going to have an impact on global trade. It's going to have an impact on the global marketplace. I think it will. I think it already has, frankly. And so, this is from Macrobond, and their suggestion is that it posts the downside risks for the ISM number. This would be the U.S. ISM number. And which, as we've seen, is like near 60. So again, I'm not hitting the panic button. I do think China is going to have an impact. I don't think it's going to be outsized, but I think it's going to be real. And I think we've got to watch China here over the next several months to see how they react from a data standpoint to recent developments. All right, here's a scatter plot of what the impact on vaccination rates on manufacturing production, and this is just a plot of basically showing you that higher vaccination rates tend to lead to higher manufacturing PMI output rates. In other words, if countries in the upper right-hand corner of this that have more of their population vaccinated are having higher rates of economic growth. I mean, that's probably as simple a way as I can probably put it. And that should be no surprise, right? And you've got a lot of emerging markets here that we know have not been vaccinated, but developed markets, by and large, still have a ways to go, but they're on a relative basis a lot more vaccinated in terms of their population than the other folks, and they've been able to show economic growth. All right, services consumption. So, we look at consumption overall, which has actually been pretty strong. Consumption has really been skewed towards towards goods and durable goods consumption, during the pandemic, and obviously services like restaurants and retail locations, have been adversely impacted here. And so, the bottom line is that, we've had this strength in consumer consumer spending and consumption, but it's been anchored in the goods side, and the services side has recovered, but we're still struggling to get out of the starting blocks on this. We have a long way to go on services consumption, and it's just going to take some time. All right, households are in great shape. This is essentially some data from the Federal Reserve and the Bureau of Economic Analysis. If you look at the upper chart here, you've got household debt, and that's leveled off. It's moving a little bit higher. We do see leverage rates moving higher a little bit. Overall, people are taking on more debt. It's low cost debt, low interest rates. But the trend line is still very muted coming out of the global financial crisis. Now, if you go to the middle chart, they plot that against disposable income. And what you can see here is very clear. So disposable income is outpacing the growth of household debt. That's a very positive thing. Households are in really good shape from a balance sheet standpoint. And then if you look down at the bottom and you're plotting basically household financial obligations, as a percent of disposable personal income, that's kind of giving you that number in a different mathematical format. And that number is really dropping as well. So households are in really good shape. Consumer confidence. Now, we have had fits and starts in consumer confidence, and it depends a little bit on the Delta variant, but there's a lot of things that go into that. Stock market is obviously an influence. You can see here in the amber line, the S&P index continues to fly north, right? Okay, but usually that there's a really strong relationship. This data series goes back to 2008, and you can see the strong relationship here. We've shown this chart before, but this gap is actually widened. And it just, it drives a lot of speculation as to which line is going to converge on the other line, or I guess better stated would be, how are these lines going to somehow converge because of this historically tight relationship between the two? Is the S&P going to drop to meet consumer confidence, or is consumer confidence going to surge to meet the S&P 500 index? I think they probably meet somewhere in the middle. And I think, again, this is a chart that helps to reinforce this feeling that that at least over the interim period that stock returns are going to be somewhat muted. We've seen a lot of a bounce back. We've seen a lot of gain, but there's a bit more heavy lifting from here. But as I've said in these charts of the week and the market minutes over the last several months, that there's clearly an impetus and there's clearly feedstock for higher equity prices from here. I just think the gains are going to be harder to come by than they have been in the past. All right, I think we're going to shift our attention now to the bond market. So here's a plot of the difference between the U.S. Treasury 5-year note and the 30-year note, or more technically, it should be the 5-year bond versus the 30-year note. And you can see that the gap has been very tight, and we've had some flattening in the curve. We've had interest rates overall kind of move down or remain kind of somewhat anchored, amidst and despite, frankly, this little spat of inflation that we've had. But the good news is here that at the end of August and trailing and kind of pushing into the first part of September, that we've seen that spread begin to widen. So this is a very, kind of a normalizing trend. You definitely want to see an upward sloping yield curve, meaning that you want to see that difference between the 5-year Treasury and the 30-year Treasury, be wider, because it's a term premium that is emblematic of a normal market. So, we hope that we will continue to see that normalization, but without, necessarily seeing a spike, because we know short-term rates are much more influenced by Fed policy, monetary policy. We know that long-term rates are influenced much more by inflation expectations. And so, again, we don't want to see this spike, because it would be probably more symptomatic of, a jump in inflation expectations. I don't think we have that right now, but again, I think a positive sign overall from what we're seeing in the bond markets. And then here's our 10-year break-even rate. So this actually speaks directly to the inflation issue. So, this is basically the difference between the 10-year Treasury rate and the Treasury inflation protected security rate. So this is what they call implied inflation. So the difference between those two products, the Treasury and the TIP, represent kind of this implied or inferred inflation rate. And right now you can see here that it's about 2.3, and it's really been anchored. So this is above the Fed's 2% level, that they wanted to see consistently, as a mechanism for them to begin to consider raising interest rates. And you can see that this break-even rate has been pretty anchored in this level for quite some time. And that's good. That's positive. I think, it represents inflation rising for all the right reasons. I think it represents kind of this coalescing of confidence at this level. The world can certainly operate very, very well. Say the world, I mean the U.S. can operate economically at a very fine level with 2.4% inflation. Historically, over a long period of time, that number is like 3%. So 2.4 does not give me any cause for concern. And I think this is positive that we're seeing this kind of, trade in a band right here. Well, the last couple slides, I'm just going to switch gears and kind of, highlight some things that caught my eye and I thought were kind of interesting. This one being one, Nevada casino winnings. If this is any indication of economic recovery, I couldn't think of a better representation. And people, this is retail risk capital at its best. It's people in the casinos and the slot machines and the craps tables and blackjack, and we've seen a huge uptick in not only bets being made, but as you can see here, winnings. So, God bless America. That is an interesting sign. All right, and I'm going to end on this one. This one just continues to shock me. Again, I'm not going to wax political here, but this is all of the material that was left behind in Afghanistan for the Taliban to use at their discretion. We left a lot of guns and tanks and people movers and even a lot of aircraft. Again, it's just hard for me to process all of this, and hard for me to process without some pain, all of what's gone on in Afghanistan over these last few weeks. Regardless of which side of the aisle you reside on, it's still just been incredibly painful. And I just hope that we as a country and our leadership can learn from all this and continue to move forward. We live in a great country. We have a good economy. I'm optimistic about our stock market, as I've said, and I look forward to great things in 2022. That's all I've got today. On behalf of the entire team at BKA, I hope you have a wonderful week, a safe week, a productive week, and we'll see you again soon. Take care. Goodbye.